The stock market is ripping higher here today, and we have a lot of news on many different fronts. We have initial jobless claims, what happened in Europe, what's going on with bank bailouts in America. We have important earnings and after hours, as well as important data that comes out tomorrow morning. Guys, the plate is filled up for us here in this video, so I do not want to waste your time. Let's get into it. S&P 500 up about 1.5%, and we're going to break down exactly why this is here in just a couple of minutes. So essentially, what is happening today is Europe, well, I should say the ECB, raised rates, and they said they will provide as much liquidity as necessary if it becomes necessary. Now, why is this so important? Well, given Credit Suisse going through essentially a long-term failure, finally going bust, well, the Swiss bank stepped in and gave them $54 billion in essentially a revolving line of credit. Now, the fact that Europe felt comfortable enough to raise rates shows confidence that this might not be as bad as investors expect it to be. Because if things were really that bad, are they really gonna raise rates? Probably not. And that's a big reason why markets are rallying here today in America. This is leading the probability of a 25 basis point rate hike to almost be solidified next Wednesday on March 22nd. Now, we'll talk about the catch-22 to this, that there's really no good outcome that could come from next week. We'll talk about that here in just 1 second. But before we get into that, I want to talk about what's happening in the banking sector here in America. As you guys know, SVB went bankrupt, Signature went bankrupt, right? It's not been too pretty. Well, you've also had fears in banks such as Western Alliance and First Republic Bank. And specifically, First Republic Bank is what I want to highlight here in this video. So, this is interesting. Very interesting. It says a group of banks are in talks to deposit more than $20 billion in First Republic, sources say. It says Bank of America, Wells Fargo, and JP Morgan Chase will contribute about $5 billion apiece, and Morgan Stanley will deposit around $2.5 billion, the sources said. Truist, PNC, US Bancorp, and M&T Bank and Capital One will deposit about $1 billion each. This is interesting. And what this article is highlighting here says it perfectly, that this is really showing confidence in First Republic Bank. Instead of a full-on bailout or someone buying First Republic, just show there's confidence from other banks that they're going to put $20 billion into First Republic. It should slow down or hopefully stop some of the bank runs that we have been seeing with these companies and put them on better footing. So that is giving the markets a lot of stability today, because it's not necessarily about what actually happens. People want to know how bad things are. And that's why, like the Fed, essentially the Fed, the ECB, European Central Bank, raising rates today was a positive thing, because it shows maybe it's not as bad as investors fear. Investors tend to go to the worst case scenario, because ultimately you want to know what's the worst case scenario. And if you start to see encouraging signs like we are today, it looks very, very good. And that is ultimately what is causing the markets to rally today. Now, on top of that, you did get some data that came out today, and it was the weekly jobless claims. They actually dropped unexpectedly. They dropped about 20,000 last week to 192,000. Continuing claims also dropped 29,000 to 1.68 million. Single family housing starts increase 1.1% in February. That is good. Hopefully more supply means lower prices. Import prices fall 0.1%. down 1.1% on a year-on-year basis. That's good. So, 2 data points which were not necessarily positive. 2 data points that were pretty positive. Now, forget all of this. what we're going to see in after hours today and tomorrow morning is going to be the real defining factor for the rest of this week. Granted, as long as we don't get more banks that are having problems and we don't get more news that is negative around the banks. In after hours today, you're going to get FedEx earnings. Now, FedEx earnings are important. They kind of started some of the pain in 2022 around March when the Fed started to raise rates, right? When the economy looked like you were going into an imminent recession, when you've seen GDP fall 2.5–3% in the beginning of 2022, a lot of this started with FedEx earnings because after all, if FedEx is not seeing good demand, then people are not spending as much money, which leads to GDP to go down, which leads to a recession and can lead to a snowball of the subsequent lack of consumer spending at that point. So we get FedEx earnings here in after hours. You're expecting some pretty bad numbers, so that might set you up for an upside beat, but it really doesn't matter. The only thing that matters to the broad markets is our people spending money. Are people shipping products? What does FedEx say? Not about last quarter as much, not about the holiday quarter. People want to know, what's the guidance look like? How is Q1 starting off? I've talked to some people that work at FedEx. I live in Michigan, and they said ever since Christmas has been over, it's been very slow. So not very promising insider information that we're getting from some employees that work at FedEx. Now, on top of that, you're going to get the Michigan Consumer Sentiment Survey coming out at 10 o'clock in the morning tomorrow. Now, this is the most important survey that the markets get. It always comes out on Friday, and it always gives you a big move because why? Well, the inflation expectations. If inflation expectations did not fall over the last month, considering these banks have went bankrupt, that's not going to be a good sign. And after all, inflation expectations lead to inflation or deflation. If people expect inflation to go up, businesses tend to raise prices accordingly. If people don't expect inflation to go up, well, prices tend to remain pretty stable. And what we have seen over the past couple of months is inflation expectations are starting to go higher, but we're not really breaking out yet. We're not really getting to alarming levels, but if some of these surveys start to show inflation expectations are starting to go higher, that's not going to be good. It's going to be a no bueno kind of situation for the markets tomorrow. And that is going to be the big thing because inflation expectations determine essentially Fed policy. Now, Fed policy, that's interesting because if you take a look at the Fed rate monitor tool yesterday and over the past couple of days, you were actually pricing in a pause to Fed rate hikes, I should say. And that's like good and bad because if the Fed went from 3 weeks ago saying, quote, we may have to raise rates faster than what the markets are expecting and to go higher than what the markets are expecting. Fed just said that 3 weeks ago. And now, 3 weeks later, to be pricing in a pause is showing a big problem. And that's, again, why it was a positive thing that the European Central Bank actually raised rates today instead of pausing. Because typically when you get a pause, you tend to get a rate cut 30 to 90 days after that pause. Now, current probabilities are 23.2% for a pause and 76.8% for a 25 basis point rate hike. Now, how this is really a catch-22, a lose-lose overall, is because if the Fed pauses, well, that shows a problem because, like I said, why did you go from saying one thing 3 weeks ago, saying you have to go more aggressive and higher for longer, and now you're pausing 3 weeks later? On the other hand, you've seen banks fail. There's no bigger sign of disinflation or deflation than that when banks are failing. You had mainstream media talking about this. So odds are that recession just got pushed a lot closer out than what it otherwise would have been. And if you raise rates 25 basis points, you're furthermore causing that recession to come a lot quicker. And it's ultimately the reason why the banks have felt so much pain in 2023 so far is the fact that the Fed raised rates so aggressively. So on one hand, if the Fed does raise rates, well, That's not good for the odds of a recession. On the other hand, if the Fed pauses, that doesn't look good for the economy right now. That doesn't look good for signals that it sends about the banking sector, about a deep problem that we might have in this banking sector. So hopefully that makes some sense. It's like a catch-22. You really can't win next week when it comes down to the Fed. Best case scenario is probably something along the same lines as the ECB did. Get a 25 basis point rate hike. The Fed says we will provide any and all liquidity we have to if crises arrive, but we don't see it getting to that point. That's probably the best case scenario. Probably not going to play out like that, but we'll see. We also do get a new summary of economic projections coming on March 22nd. So we're going to get the new dot plot to see how high Fed members think rates are going to go. You went from expecting almost 6% for the Fed terminal rate now to just over 5%. And at one point in this week, the markets were expecting 2 rate cuts by the end of 2023. No Fed member has even said they're even considering rate cuts in 2023. So there's going to be a lot of expectations heading into this. A lot of expectations are going to get blown up. That is going to be next week, but the data we get tomorrow, Michigan inflation expectations, that's gonna be a good step and a good sign to potentially what Fed policy is going to be. Inflation expectations going up, bad. Inflation expectations going down, good. And that's the bottom line, really what you need to know here in this video, guys. So expect a lot of volatility. We covered a lot of ground here in this video. Hit that like button, subscribe to the channel, source your comments, questions, or concerns down below in the comment section if you have not already. Thank you for watching, and I will see you in the next one.